The market is open and we're seeing strength pretty much right across the board, although we are noticing some weaknesses today in the semiconductor space, but overall they are fine with some very large gains in 2024. Now today we're focusing on Pfizer to understand, is this a trap or is this a great opportunity to buy a company towards its 52-week lows with a very nice juicy yield of 6.3%. Now we're going to take a look at their latest earnings. We're going to run through a lot of information as well as some insider buying that we have noted. And the first thing we want to start off today is understand their earnings from a couple of weeks ago. How did that look? And the title gives it away. Pfizer tops earning estimates whilst they've also hiked their full year guidance. Great to see for a company that has previously struggled. And when we look at the actual numbers for which this company did report, 106 on the EPS, very strong from the 62% the market anticipated, and the revenue as well, 17.7 versus the 14.95. So great to see a phenomenal quarter from Pfizer. And as we already alluded to, they did increase their EPS 275 to 295 from the previous guidance of 245 to 265, and it doesn't just stop there. They also hiked up their revenue guidance 61 to 64 billion, as we can see previously anticipated 59.5 to 62.5. On top of that, when we look at their bottom line net income for this recent quarter, 4.47 billion, that is a positive, a net income. However, the same quarter last year, they brought in a net loss of 2.38. So looking good for this company in terms of what they have just previously reported. And if we look towards the future, the next 4 quarters, we do understand that 3 of them, they're expecting a decrease, although the next quarter, a very large increase of around 372%. And one thing we do like about Pfizer on a historical basis, by quite some distance, they have outperformed what analysts had anticipated, 100% track record, giving us faith in terms of management's historical forecasting accuracy. Now we do have to flag over the next full year, they are expecting a very small drop to the EPS, which will increase that forward P, although marginally, to around 9.2. Now in terms of the historical performance, as we can see on the day, down more than 1%. Over the last 12 months, it is down around 14%. Over the last 10 years, it's actually down 13%, meaning if you'd bought this company 10 years ago, your investment would be less than what you put in during that time. So not the greatest from a historical aspect. And we also note the peak price around $60 December 2021. We're talking around 3 years ago. Now, as we mentioned earlier on, it is trading towards its 52-week lows, a very attractive yield at 6.3% and a forward P of 9.12. We'll compare it to the sector, but no surprises for those that already guessed it is well below the essential industry. We also have here a double buy signal from Seeking Alpha in Wall Street, but as we have previously discussed, whilst Quant have given this a hold, 3.5 would be a buy, so at 3.45 we would be fair enough in saying that they are sitting on the fence between a hold and a buy position. So let's take a look at essentially their latest quarter. Now we already discussed very strong in terms of their revenues, up significantly. Not only is their revenue up, their cost of sales are down, and we also noticed their earnings per share, which we did already mention, up. So looking very good in terms of this quarter, and we already discussed historical accuracy, last 4 quarters, very strong as well. In terms of their year-to-date performance for Q3, something that maybe you don't look at for all of your companies, but how this company, Pfizer, allocates their capital is very important. 7.1 billion is returned to shareholders through the yield and the increases that we see on the year-on-year basis. One thing we love from companies where they put their focus on being a very healthy company in terms of the balance sheet. 4.4 billion in terms of paying down debt. We're going to cover this later on in the episode. 7.8 billion in terms of internal R&D, research and development for new products. And we can see here, whilst there are none planned in 2024, always great to see that they have included this share repurchase. And at some point when they do bring this back in, we will make note of it as well. We can also see here, post the CGen delevering. Remember this acquisition, very strong. We do quite like this from Pfizer. Hopefully it will show up in the numbers moving forwards. They expect their capital allocation to be both reinvestment and returning value to shareholders. So I do like the way management are talking about this company. But as always, one thing is to talk and the other thing is to show up and actually put this into action. Finally, whilst we've already shown you just a clearer way of seeing it, their increases to their revenue guidance 61 to 64, the same to be said for their earnings per share. So great news so far in terms of this company. Now let's just refresh yourselves on the metrics based on this updated information. Dividend safety score 75, severe undervaluation on the yield. We'll discuss severe undervaluation here again, but one thing that we don't like is that increase last December below inflation at 2.4%. Remember, over the last 40 years, US inflation has been around 4% year on year, but this also flags to us that we are expecting an increase from Pfizer next month in terms of that dividend, and we can see reaffirmed, in fact, just a few weeks ago, that safe score, which means a dividend cut for Pfizer is unlikely. Now, how did they perform in the last recession, the 07-09 crash? They actually cut the dividend, so something just to highlight. They had above average growth, -6% recession sales, S&P -12, but they did, although marginally, outperform the S&P, -45, S&P itself, -55. Now, we've already discussed, disappointed about their increase last year, but nice to note for a company that pays a yield of above 6% over both the last 5 and the last 20 years, at a bare minimum, they're keeping up in line with inflation. We can see 13 years of consecutive increases as well to the dividend. Now let's take a look based on their P ratio, the undervaluation noted, the blue funnel here being the expected fair price. Right now it is right at the lower end, if not in fact out, therefore giving us that severe undervaluation signal. But remember, we're not looking at any one of these models in isolation. We will conclude towards the end. We then move on to dividend yield theory, telling us a company is undervalued when the current yield is above the 5-year average, 6.36, above the 5-year 4.07, massive undervaluation, and another undervaluation, forward P 10.5, below the 5-year 11.7, and in fact significantly lower than healthcare 16.8. So it is trading at a severe discount to the overall sector, but we're going to run through comparatives to understand, does it actually deserve the discount, or in fact has the market massively overreacted, giving us a glorious buying opportunity. Now, as always, focusing on the free cash flow, earnings susceptible to manipulation by management through accounting, below 60% is what we want to see. And look, this is one of the reasons why we draw your attention to the free cash flow. In 2023, 89%, you would have said that is a little bit too high. But what we flagged here, 193% on the free cash flow, indicating management paid out more in dividends than they generated in that free cash flow. Nice to see though, over the next 12 months, this is anticipated to come down to 66%. Hopefully we can get more to the consistent and regular 4 to 5% increases they have shown historically. Now, free cash flow, we want increases consistently over the longer term. In fact, it was flat pre-COVID, then COVID arrived and we can in fact see it doubled and was fairly high. Then it had the post-COVID drop to 85 cents. Now we can see with all the cash generated, they are doing internal R&D, a lot of money spent, as well as those acquisitions, and they anticipate 253, so a large increase to the free cash flow over the next 12 months. And we can see the percentages of that sales growth below. No surprises why any of these numbers are shown. 42% drop in 2023, trailing 12 month also showing another drop is anticipated. And when we look at it from a numerical basis, 50 billion in 2014, doubled to the peaks of COVID in 2022 at 100 billion, and then down in 23 to 59. Now, shares outstanding, whilst we love it when companies return excess cash through share buybacks, as we just saw in their latest presentation, they're not expecting to do any for the time being, but over the last 10 years, it is something they have done, and we have noted they've bought back more than 10% of the initial shares in 2014, around 720 million. Now, in terms of ROIC, 10% or more, give us faith, management are able to effectively allocate their capital, one of our favourite metrics. Now, it has looked good over the last 10 years, although we do see a large drop into 2023. But what we do notice here on a trailing 12 month, it does look like it has started to pick back up. Now, operating margin, we don't notice any operating efficiencies, which is this increasing over longer term. But for the large part, it is above the minimum 12%. And whilst it dipped into 2023, always good to see a comeback, 19% on a trailing 12 month. In terms of free cash flow, no worries whatsoever, above the minimums, and again, even though it did drop to 8%, trailing 12 month looking like the next year is going to be a fairly positive one for Pfizer. We then get to the net debt to EBITDA, the earnings before interest, tax, depreciation, amortization. Below 3 is what we want. Reason for this, these are the number of years it would take the company to pay off all of their debt net of cash on hand, and this signals how strong the balance sheet is, how secure the dividend safety is, and whilst it has increased in 2023 into the peaks of 3.75, trading 12 month at 2.46, expected to come down over the next 12 months is a good sign in terms of the health of this company. We just need to ensure they do execute and continue, as they said, to de-lever the balance sheet. Now, we also want to let you know we have just released our latest free weekly article. We drop one every single Monday morning to your inbox where we cover severely undervalued stocks that deserve your attention, as well as what's gone in the market over the last few days. So click below, sign up, and you can read straight away. You'll also gain access to 40 undervalued stocks for the month of November. Lots of information, the upside that Wall Street themselves see over the next year. And on top of that, you can grab a spreadsheet, 22 undervalued dividend stocks that Wall Street themselves believe have the most upside in the whole S&P 500 right now. So click below, sign up, and you can read straight away. We then move on to insider ownership at 0.06%, and we see no selling over the last year, but we actually see some buying $108,000, and in the more recent quarter, $28,000, as we see here. Who this is? Well, the director, he bought around 1,000 shares on the 30th of October, so just under 2 weeks ago. Now, insider buying, we believe bullish signal. Insiders buy because they believe the share price will go up over the longer term, but you could argue this is fairly trivial, not the largest amount. Information though is there if you do want to include it into your own investment thesis. Now, institutional ownership, 68%, around 9 billion worth of sales over the last 12 months, but around the same amount of buys during the same time frame, 8.7 billion. So they are a little bit undecided. One thing that we can note, nearly 3 times as much buying by the institutions in the more recent quarter. Regardless of what institutions do, buy or sell, always do your own due diligence and never copy what they do. Now, we've already shown you their top line revenue, how inconsistent it has been over the long term, and very much minimal movement from the 50 billion in 2014 to the 58 in 2023. But we do want to flag the bottom line net income, something that we haven't covered, and we want to see what story it tells us, which is very inconsistent, kind of following their top line revenue, 9 billion in 2014, 2 billion in the latest annual accounts. So do understand that this company is very inconsistent and we always need to keep up to date with what's going on, but just something again to flag for those that are considering. We then move on to the balance sheet, very important, health check, cash versus total debt, and we notice their cash has actually decreased over the last 10 years, 36 billion in 2014, just under 10 in the latest quarter. As always, one number is never going to give anything away in a balance sheet, which is why we look at it numerically and directionally, essentially in comparison to the total debt, which for the large part has stayed flat, although we do see a jump from 22 to 23, going from around 37 billion in 2014 to 68 in the latest quarter, and we did see a spike to the net debt to EBITDA, so definitely one we would flag as consider this when you are looking at your margin of safety. Remember, the free cash flow payout was triple digits in 2023, net debt to EBITDA was at their peak, so lots of things that you really do need to consider. Then we jump into the valuation. Now they get a D+. What we can in fact see here though is the P on a non-GAAP gets an A, 9.12, massive discount to the 21.3. So if you're buying Pfizer right now, you're getting a 57% discount to the sector. Is it worthy of a discount? Well, look, whichever valuation metric you do use today, that is what it is telling you. Then we move to the growth grade where they get a D-, so maybe a discount is warranted. Negative 14% year on year, sector at 7.4. Moving forwards, negative 14 again, sector at 8.4. And one thing we do like to flag is the EPS over the next 3 to 5 years, 7.7% growth, whereas we see the sector median at 11.1. Profitability, on the other hand, does look very strong with an A+, 70% gross margin, 58% for the sector, 7% for the bottom line, where the sector median negative 4%. And on top of that, their cash from operations, 11.3 billion over the last 12 months, with the sector median negative 14 million. So quick recap, double buy from Seeking Alpha and Wall Street, hold or on the fence, hold / slight buy from Quant, D+ on valuation, D- on growth, with an A+ on profitability. Now, 2 things before we do jump into the valuation. Quick comparison against other pharma companies over the last 10 years. Pfizer, total return including dividends reinvested, down 8%, the worst performing, And actually, this is an issue isolated with this company, as others have all been positive over the last 12 months. And then we look at over the last 5 years and we can see again negative 6.7% and isolated as others all positive. And then we move over the last 10 years, up only 37%, one of the lowest performing, but actually some of them have also been equally as bad. In fact, only really AstraZeneca and Zoetis would be ones that you would be happy with. Just doesn't mean though, because Pfizer have been terrible over the last 10 years, they will perform as bad. They could be even worse, they could be significantly better. As always, past performance does not define the future. Then we want to highlight the comparison against the essential S&P. Over the last 12 months, S&P outperformance. Over the last 5 years, massive outperformance. Over the last 10 years, again, more massive outperformance. Do remember though, look, it could be a lot better, but always do consider having the S&P 500 in your portfolio if you don't have confidence that these companies will outperform. We do also understand there will be other investors here who will be watching this and are considering it purely down to the very high yield. So lots of things that we are just flagging in today's episode. Now let's jump into our intrinsic value. As always, if you do enjoy the content, value is being provided. Smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now our intrinsic value of $37, let's run it through very quickly. You have Graham's valuation, EPS, long-term growth, AAA corporate bond yield, giving us a massive undervaluation signal in today's episode. Just remember, we're not looking at any one of these models in isolation. Then the multiples, couple of companies in the similar sector and size. Average P multiplied by the EPS of Pfizer, another massive undervaluation signal. Then we move to the dividend discount model. Average growth rate over the last few years at 3.14. Forward looking, we've gone for 3. Again, we notice another undervaluation signal, so 3 for 3. Then we move on to the DCF model, where we have the free cash flow year on year, average growth just under 4%. We've gone for 7 around targets of management. With the discount rate, we have the present value of future free cash flow and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and as we can see, a fourth undervaluation signal, 4 for 4. Average price $37. That is our intrinsic value today, covering these 4 models. And as always, we like to use a margin of safety on this channel. Now remember, you can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for Pfizer or any others. So we start off with 10% MOS, execute on that if it meets our 3 golden criteria. Wide moat, strong financial metrics, good forward-looking data. If you believe that in today's episode, we'll look a buy up to $33.40. Then we keep going till it's near the current trading price. And what we can see in today's episode, not far off a 30% MOS, so we would say Pfizer between 25 to 30%. In terms of Wall Street, their price target over the next 12 months, $33, upside of 25%. As we saw, they did have that buy signal, so 25 to 30% MOS, 25% upside. Is this one you are looking to buy, maybe hold, or maybe sell? Now, before you do consider, there were a lot of red flag indicators that we ran through today, so just bear these in mind. They might not put you off buying this company, but do have realistic expectations for the future. As always, if you enjoyed today's episode, smash that like button, hit that subscribe and bell button. Don't forget to sign up to the free weekly newsletter below, and come and join us in the Patreon where we do talk about our weekly buys and sells. As always, have a great day, and we'll see you all on the next one.